G'day folks. Now that the Leafs are done their season, we can get back to the regular programming. So Friday, the US was downgraded by Moody's, which is the last of the three big rating agencies to downgrade the US's debt. The first one to do so was the S&P Standard & Poor's back in 2011. So this isn't groundbreaking. I mean, Moody's was the last to do so, but nonetheless, it is meaningful. It just more or less, as another brick in the wall of the US's fiscal stability falling apart. The markets are reacting a little bit to this today, but I think what's really going to be interesting is when the Republicans put the budget bill to the House, try and pass it with those tax cuts. And similar to what happened with Liz Truss in the UK, if the market does not agree with the fiscal plan of the US, you could see interest rates in the US higher, which would be quite devastating to the market because the 30-year treasury right now is already at 5% and heading higher. Also important is Japanese interest rates are up around 3.5%. Given the amount of debt that Japan has, this is also very important. Those are the two key things happening right now in the global economy is US rates and Japanese rates. What does this all mean? What does it mean for Canadians? I think one thing you have to realize is that the markets always tend to go where is the path of least resistance. So what that means is it'll probably end up, the lever that will get pushed the most will probably be the currency markets. So eventually, when the market comes around to realizing that the US is not capable of getting its fiscal house in order, I think eventually they're going to have to start buying debt to support the bond market to prevent interest rates from going sky high in the US, which means printing currency, printing money, and therefore the US dollar will continue to slide lower over the next few years. When you're thinking about your investments, when you're thinking about Canadian interest rates, mortgages, real estate, in the back of your mind, keep in mind that the theme going forward from here is going to be weaker US dollar. So what does a weaker US dollar mean for those things? If anything, any asset that trades against the US dollar, that means that asset will appreciate. For instance, gold. Gold primarily trades against US dollar. So as the US dollar goes down, gold will go up. Same for a lot of precious metals. If you're thinking of Canadian investments, if it's a company that predominantly depends on a weak Canadian currency because it exports a lot of its product to the US, that type of industry or that company is not going to do so well as the Canadian dollar strengthens against the US. With regards to Canadian interest rates, as the Canadian dollar strengthens, that is going to lower inflationary pressures in Canada, which will enable the Bank of Canada to lower interest rates, which will support the real estate market in Canada. So that's good for real estate in Canada as the US dollar weakens over the months and years ahead. All in all though, in the back of your mind, you should be thinking that the main theme going forward from here is a weaker US dollar. All right, have a great day. Bye.